Morning, everybody. We'd like to bring the Investment Committee meeting to order. The first order of business would be to call the roll, please.
Rob Fechner.
Good morning.
Teresa Taylor.
Hi.
Margaret Brown. Morning. Dana Hollinger.
Excused.
Henry Jones. Fiona Ma, represented by Frank Rufino.
Present.
Lisa Middleton.
Present.
David Miller.
Here.
Arena Ortega. Jason Perez.
Here.
Mona Pascual-Rogers.
Here.
Ramon Rubalcava.
Here.
Betty Yee, represented by Lynn Paquin.
Thank you. The next order of business will be the approval of the June 17th timed agenda. What's the pleasure of the committee? Moved by Taylor, seconded by Pascual-Rogers. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
Opposed, no. Motion carries. Item 3, Pledge of Allegiance. Ms. Taylor, would you please lead us in the pledge?
Certainly. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Item 4, Executive Report. The Chief Investment Officer briefing, Mr. Meng.
Good morning, Mr. Chair, members of the Investment Committee. We have a busy agenda this morning. In addition to the usual standing monthly update reports, we have 3 items for you. 2 information items and 1 action item. The action item is item 8, which is for the affiliate trust asset allocation review for the California Employers Pension Pre-Funding Trust. And the 2 information item, the first one is item 7, which is a continuation of the investment education workshop provided by the CFA Society. And the other information item is item number 9 on mitigating drawdowns. This is, as you recall, that last month as the first investment education workshop delivered by Mr. Jeff Bailey. There were 2 topics generated some discussions among the board members, committee members. These 2 topics are capital market assumptions as well as the impact of a market drawdown. So item 9 was specifically prepared to address these 2 questions that you raised from last month's discussion. With that concludes my report.
Thank you. I have a question, Ms. Middleton.
No, I did not.
Oh, you must have bumped it. All right, seeing no other requests, thank you. Agenda item 5 is the action consent items. What's the pleasure of the board?
Second.
Moved by Jones, seconded by Taylor. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
Opposed, no. Motion carries. Item 6, the information consent items have no request to move anything off. Brings us to agenda item 7, about 27 minutes too early.
Jeff does have a flight to catch later, so that's good.
Can you do item 8 in that period of time, or do you want to move on to number 9?
We need number 7.
It's time certain at 9:30.
Okay.
So you either have to get up and do a soft shoe, or we have to do one of those other items.
How much time we have? 20 minutes?
25 minutes?
25 minutes.
25 minutes. So let me take item number 9, please.
Very good.
So item number 9, the slide, please. Mr. Chair and members of the Investment Committee, I just mentioned that this item was prepared to address your specific questions from last month's investment education workshop. There were 2 questions raised back then. How do we formulate our capital market assumptions, mainly in the expected returns? And why do we say that the returns for the next 10 years is less likely to be as good as the past 10 years? And then the second question, what caused a market drawdown and how damaging a market drawdown can be? And more importantly, what can we do to prepare ourselves for a market drawdown? So these are the two questions. First, how do we formulate capital market assumptions? How do we forecast future returns of major asset classes? Most people use a building block approach. So this approach, each asset class is viewed by its ability to first to grow with inflation. Okay, so I guess the animation is not working. Let me go back. So as you see, the bottom block, the first block is inflation. So each asset class is viewed by its ability to grow with inflation, basically to preserve purchasing power. Then the second building block is to earn a risk-free rate. And normally people view a U.S. Treasury, a U.S. government bonds rate as the risk-free rate. So these two blocks forms the foundation of the expected return of any major asset classes. And on top of that, then each asset class has offers different risk premium, such as equity premium, liquidity premium, credit premium or spread premium, and emerging market premium. So these are normally the building block approach. For example, for public equity, you will see inflation, risk-free, and plus equity premium. For private equity, you will see inflation, risk-free rate, again, the two basic building blocks, plus equity premium and then illiquidity premium, because private equity is less liquid than public equity. So this approach offers a theoretical elegance, but in practice, it's difficult to estimate each component of it, as well as the correlation among them. So in practice, fortunately, we have a simple yet effective indicator for each of the two major asset classes in our portfolio, which is the public equity and the fixed income. And as we know that in the long run, valuation is the variable that matters the most in terms of the future return in the long run, in the 7 to the 10 years period, the period that we are looking at. As I said, for the two largest asset classes, stock and bond, we have two very good empirical indicators to tell us what the future return is going to be look like. For a bond, yield to the worst or yield to maturity is a very good indicator of future returns. And then for stock, the forward earning yield is a good indicator of future returns as well. So this slide shows that how are our capital market assumptions relative to our peers. This slide shows the 6 major asset classes. The orange bar shows the range of our global peers from the largest survey available, the Horizon survey. I believe it surveys 34 of our global peers. What's their capital market assumption? What they expect the return in the future? And for each major asset classes, and then the white dot in the middle is where we are. So the key takeaway on this slide is that our capital market assumptions is within the range of the industry. And also important to note that during the 2017 asset allocation, asset and liability management workshop, we formulate our expected return for the next 10 years. For the next 10 years, the portfolio expected return is 6.1%, not 7%. And from the 11th to the 60 years, our expected return is 8.3%. And if you take out of the administrative expense and then average the first 10 years plus from the 11th year to the 60 years, if you average them together, it turned out to be for the next 60 years, our expected return is 7%. But for the next 10 years, our expected return is 6.1%, not 7%. So this slide, when we say our expected return for the next 10 years of the portfolio is 6.1%, this is not a point estimate. It comes with a wide range of distribution around 6.1%. The 6.1% is only the mean of the expected future return distribution. So this means that you see the range in the middle, the 68%. So with 6.1% expected return and 11.4% of expected volatility, we would expect that 68% of the times in the future, our return will fall between 5.3% and 17.5%. And 95% of the times that our future return will fall between 16.7% and 28.9%. And you can go for 99% of the time that our expected return falls between negative 28% and positive 40%. So there are three takeaways on this slide. For one, again, our 6.1% is not a point estimate with a wide range, so that no one, we highlight these points so that no one is alarmed by realized future returns that are different from 6.1% or from 7%. It's never meant to be a point estimate. The second point on this slide that you can see on the left side, we are more concerned with left side, the probability of a large drawdown. So that's what we mean by drawdown. And as you will see in a later slide, that drawdown can easily wipe out the returns, good returns from a couple of years. The third point is that the drawdown, the conventional risk management practice and framework, tends to underestimate the probability as well as the severity of a market drawdown. So that's the second part of the discussion this morning, the market drawdown. So as I said in the previous slide, that for the two largest asset class in our portfolio, global equity and fixed income, we have, for each of them, we have a good and simple indicator for the future returns. The x-axis show you that is U.S. Treasury real rates since 1962. And as we said that for fixed income, for bonds, the yield is a pretty good indicator of a future return. And the y-axis is the earning yield of a global equity, which is a good indicator for future return as well. As you can see that on the upper right-hand corner, where we have the happy face, so that was during 1981 recession. And at that time, as you can see that back then, U.S. Treasury offers a real yield about 8%, nominal yield about 14%. And the equity earning back then, the forward earning yield is about 8% as well. So these are real yield. And we put it together as a 60-40 portfolio. If you look at our portfolio today, it's not that different from 60-40 portfolio. When we say 60-40 means 60% roughly in equity exposure and 40% in bond exposure. So currently our portfolio in global equity is about 50% and private equity about 8%. So I'll add up the equity exposure about 60%. And then our bond exposure, fixed income, about 27-28%, plus the real estate. Now we run our real estate portfolio as a U.S. core real estate, so behave similar to a bond. So if you look at our portfolio together, we are not that different from a 60-40 portfolio. So for a 60-40 portfolio in 1981, during that time, when the happy phase, the expected return is 14.7%. And our discount rate back then was only 8.5%. So the reason for the happy face is that back then the job was easier for the staff to deliver 8.5%, when the risk-free rate alone gave you 14% already. So the staff was happy, and the members and beneficiaries and employers would be happy as well, because we could easily deliver that return. But today's environment, if you look at the lower left-hand, so that's where we are. So if you're using the same methodology, today's nominal expected return going forward, using 60-40 portfolio, only public asset only, it was 4.3%. However, our assumed rate of the return is 7%. So there is a gap, it's about 3% gap already. So the headwind today is about 3%. Back in 1981, the tailwind is about 6%. So that's why we say the return for the next 10 years is less likely to be as good as the past 10 years.
Mr. Meng, do you want to take questions as you go or wait till the end?
I can take questions.
Okay, yeah. We have one for you. Ms. Brown.
Thank you. Can we go back to slide 3? Thank you.
Oh, sorry.
So in our board packet, we don't have the year 11 to 60 years, 8.3% expected return. So So what's going to make returns go up? So for the next 10 years, they're going to be 6.1 on average, and then they're going to go for year 11 through 16 to 8.3%. So what do we expect to change in the market, assuming we don't change our asset mix?
So what, in this case, the 8.3% from 11 to 60 years is really a long-run average. So in the long run, if you look at this chart, we're assuming that we will move back to somewhere more comfortable place, and then we can start earning 8% return. But currently, because we are in the lower left-hand corner, the forward-looking return is lower than the long-run average.
So we think that the Fed funds are going to change their rates on interest. I mean, what's going to get us to 8.3%? I'm just trying to figure out what would. I just came off of a week at Wharton on investment strategies, so would love to talk to you about convexity and all other kinds of things. But why don't you just tell me what we think is going to happen in 11 to 60 to get us to that higher number?
That probably is better to be addressed by our actual office, who formulated the long-run return.
Okay, well, we can wait to answer that. It's not that simple. Like, I thought it was going to be a simple answer.
Yeah,
Okay.
so Ben, I think she's asking, so if we're assuming we're going to hit 7, but the CMAs say 6.1, do we have any specific strategies that we think gets us closer to 7? So what are you thinking about that delta?
Well, that's the question we think every day, every waking moment of the investment office. So that's not an answer that I can give you a simple answer. That will be an ongoing project for years to come.
Great. Okay, thank you.
Thank you.
Mr. Perez.
Ben, Mr. Mang, sorry. You said if you take out the administrative costs, so I'm confused. Are these return rates net?
Yes. So the 7% for the long run, 6.1% for the next 10 years is net of administrative expense.
Okay, and then the second thing is I appreciate the happy faces, because that way I know which way to look. Thanks.
Let's all hope for that.
Go ahead.
Okay.
Oh, what? One more.
Thank you.
Mr. Jones.
Thank you, Mr. Mang. My question goes to the impact of all of this. We have our discount rates and our expected returns, and if we don't achieve those returns, it flows through and affects our funded status.
Yes.
And I think it's important to note that when we have a 7% discount rate and we get 5 and we lose money, that let's say 2% drop, then it's going to take more than 2% to get us back to where we were.
Correct.
Because of the transaction where if you got $1 and you lose 50% of that, you go to 50 cents. And you go 50% up, you don't go back to $1, you go to 75 cents.
Correct.
So why it takes so long? What's this long period of time to regain that money that we lost? Because it's not going to be in the same length of time because you're now dealing with a lower base. So how does that play into your?
Yeah. So if you may, we have another slide later, just specifically to address that question.
Okay. Okay. Thank you.
Thank you.
Ms. Taylor.
Sure, and I just wanted to ask, so as we were looking at your graph with your happy face and sad face, the nominal expected return back in 1981 was 14.7. There was a discount rate of 8.5%. Bonds were making more money. Can you give us a little background, just sort of for our folks, on why that was?
Yeah. So that was, if you remember, in the 70s and 80s with the hyperinflation, and that was Paul Volcker trying to fight to rein in inflation. So he raised interest rates very aggressively, and which caused a recession. When recession happens, the asset class tends to be cheaper. So that's why during the recession time, the equity, you see the y-axis, offers very attractive return. And that's gets from the point that I would like to discuss in the second half of the slide. When the recession happens, when the crisis happens, first let's make sure that we can pay all our bills. And on top of that, make sure we can generate some liquidity or dry powder so that we can deploy. We can deploy and take advantage of the market dislocation during time of a crisis.
Excellent.
So that what happens during that was Paul Volcker raising interest rates caused a recession. And normally, when the recession happens, you lower interest rate. But the fact that he raised the interest rate to cause a recession, that was time interest rate was really high, above 14%. And we were only trying to earn 8.5%. So it was much easier back then. You could have just, buy the government bonds and, in absence of or reinvestment risk or the drawdown risk. So you still, even with the reinvestment risk, with 14% treasury yield, you're trying to earn 8.5%, we would have come out in much better place.
Which kind of leaves us in a situation now because we're already at low interest rates. There isn't a lot
Correct.
to do
Yes.
if a downturn occurs.
Exactly.
But I will also say, and because this sounds all very scary for our members, I just want to say that we've been talking about this 6.1% return for the last couple of years, 3 years or so.
Yes.
So we're working our way out of it. and I also want people to remember we've had good return years for the last few years, and I think it's important that we, this is not an exact science.
Exactly. Thank you. Yeah.
Ms. Middleton?
Yes. Thank you. Looking ahead to the next 10 years, are you more concerned about inflation or deflation?
I personally am more concerned about deflation. But later, I have a slide on that one as well. So where we are going from here today is really two extremes. One is the Australia scenario, and the other one is a Japan scenario. So these are two extremes, and probably we are somewhere in between.
Knowing the impact that taking the discount rate from 7.5% to 7% had on municipalities across the state, seeing a 6.1% number is
concerning.
I'm looking for the right word, and it's not coming. Scary is only the beginning.
I guess my point is that no need to be scared, but we need to stay focused. Focus on doing the right thing, the most effective and impactful thing for the portfolio.
Go ahead, Mr. Meng.
Yeah. Okay, so the second topic of this agenda item, what is a market drawdown? What can drawdown do to us, and what can we do to prepare for a market drawdown? Simply put, there's no commonly accepted definition. What is a market drawdown? But we like this definition from Wikipedia. So putting it plainly, a drawdown is a pain period experienced by an investor between a peak and a subsequent valley of the stock return. So we like this definition because it also highlights the element of pain. Means that the drawdown and how long the market stay low, the duration of the market drawdown. So we define market drawdown as a 20% market decline for a period of longer than 3 months. So as you can see that since 1987, we have 3 such market drawdowns by our definition. And market drawdown tends to coincide with economic recessions. You see the gray bar, that's economic recessions, but it does not have to be always the same time. As you see the 1987 market crash, the market drawdown that did not come with a recession. The recession came in 1990 and 1991 when the tech bubble bursted. So that's what our definition of a drawdown. So why do we care about drawdown? So this goes back to Mr. Zhong's question just a moment ago. If you look at the pension buck, the pension dollar, 59% of the benefit payments are from investment returns. And we manage the 59%. And if there is a drawdown, a large drawdown in the 59 cents of the portfolio, it will negatively affect the 28 cents and the 13 cents, which is the employer and the employee contributions. So we care about drawdown deeply because we view this as a shared responsibility, and it is our responsibility to manage the 59 cents of the dollar as prudently as possible and to mitigate drawdown. So we care about drawdown deeply, and we are vulnerable to drawdown. And I want to say something that we are vulnerable to drawdown by choice. And what do I mean by that? We are vulnerable to drawdown by choice because there are no other options. This is the best option we have. So why do I say that? You first look at the top, on the left top box, the underfunded status. So there are two main reasons. One, our underfunded status, currently we have funded status about 70%. And in order to close the funding gap and at the same time maintain the affordability of the pension system to our employers and members, we have to take on risk in the portfolio to close the funding gap. And then the other reason is, as I just showed you, that our assumed rate of return is 7%, and the risk-free rate return today is 2.25 to 2.5%. So that there is a gap of 4.5% right there. So in order to make up that difference, we have to take on risk. So because of our underfunded status as well as our high assumed rate of return relative to risk-free rate, we have to take on more risk in the portfolio. However, for a risky portfolio, that comes with a potential for larger drawdown. So that's what I meant by we are vulnerable to drawdown by choice, because there are no other better choices. And we are more vulnerable to a larger drawdown because of the riskier portfolio. What compounds the challenge is that the timing market drawdown is not predictable. So what do we do? So if there's one takeaway for the entire presentation today, I would like you to think about these two, the last 2 points. So in this case, what do we do? Drawdown is very impactful. We care about drawdown, and we're vulnerable to drawdown by our choice, and the timing for drawdown is not predictable. Then what do we do? So first thing we do, before the drawdown, we establish a plan. And then during the drawdown, make sure we stick to the plan. So that's what we should do. And again, as I said, if there's one takeaway for this entire presentation, this will be the point I will come back again later, over again in the later part of the presentation. So this is a real example, recent example, why we care about drawdown. Again, back to Mr. Zhong's question. So this is, if you look, this is S&P 500 total return from October 2007 to March 2012. As you can see that from October 2007 to March 2009, where is the lowest point, S&P in that 1.5 years period, S&P 500 lost 50%. And to earn that 50% loss back for the next three years, from March 2009 to March 2012, the market had to earn 100%. Just to make it back to where it was in October 2007. So this is asymmetrical return. You need 100% gain to make up a 50% loss, and that was Mr. Zhong's point. So for these 4.5 years from October 2007 to March 2012, we lost the opportunity to compound our asset at 7.5%. Back then, our assumed rate of return is 7.5%. So basically, in the 4.5 years period, we made a round trip, but we lose the opportunity to earn a 7.5%. What makes it even worse is that you look at the top line, the dotted red line, the dashed line, that is our liability. For the same time period, liability never experienced a drawdown. Liability continued to grow. So not only we lost the opportunity to compound our asset at 7.5%, on the flip side, the liability continued to grow. So the net result is that our funded status decreased and contribution rate increased. So that's another reason why we care about drawdown deeply. So now I have concerned you enough with the negative impact of a drawdown. What is really likelihood of a drawdown? So on average, the economic cycle is, let's say, about 10 years. So you are 6 or 7 years in good time, and then you have 2 to 3 years very bad time. So that's a drawdown time. So let's say that on average, that's the case in history. So that what we call the unconditional probability of a drawdown for the next 12 months is about 15%. So this is unconditional probability, means that you are not conditioning on anything prior of where we are on the economic cycle. However, if we believe that we are in late cycle, the conditional probability for a drawdown in the next 12 months is much higher. The recent estimate by New York Fed is about 30%, and the latest estimate by San Francisco Fed is 44% of a drawdown in the next 12 months. And it is important to know that the estimates are based on history and backward looking. So it's only if history is any indication. Going forward from here, as you hear from the news a lot, is that we are becoming the longest economic recovery in the United States, in the history of the United States. From here going forward, as I said, that the outcome of our economic recovery has a wide range of outcome as well, but bounded by two extremes. On the upper end of the extreme, the good end extreme is Australia, that has experiencing economic recovery for close to 30 years, since 1990, 1991, and is still counting. So that is the good end of the extreme. On the bad end of the extreme is Japan, after close to 30 years, still has not fully recovered from its economic downturn in 1990 and 1991. So you have these two extremes. That's what we haven't seen in the past 30 years. So this is the range of the outcome we're experiencing. And yes, it is true that, again, we are on our way becoming the longest economic recovery on the U.S. In the U.S. history, and when you hear that news, most people are implying that the drawdown is near, it's coming. But we also know that economic recovery does not have to die of old age either. So what's going to happen from here? We always hope that our economic recovery can be as long or even longer than the one that Australia is experiencing. But we have to acknowledge that we are in uncharted territory. The reason is that if you look at the past three recessions, in the 1991, the Fed cut 5.75% to stimulate the economy. In the 2001 recession, the Fed cut 4.25% to stimulate the economy. And in the recent global financial crisis in 2008, the Fed cut 5%. And then also engaging in a large amount of quantitative easing. And according to estimate by Bloomberg, that will put the cut in the most recent global financial crisis in 2008 of 7.75%. And one of the reasons I said that we're in uncharted territory now, currently the Fed fund rate is 2.25 to 2.5%. So basically, we don't have another 7.75% to cut to stimulate the economy should the next drawdown, next crisis comes. And the other thing is quantitative easing. The capacity of quantitative easing is not unlimited. So when the next drawdown comes, monetary policy is less likely to be effective. So that's what we mean that we are in uncharted territory. So now I have concerned you enough about drawdown. What have we been doing to prepare ourselves for the drawdown, and what we'll continue to do to prepare ourselves? So what has already been done to prepare for a drawdown? So the first, we lowered the discount rate from 7.5% to 7%. And secondly, we have a new asset allocation. This new asset allocation really started from the 2017 asset liability management workshop. And at that time, it's this body, the investment committee, under the leadership back then, you adopted portfolio priority, you adopted mitigating equity market drawdown as the top portfolio priority. And because of that decision by you, directed the staff to review the major asset classes, global equity and fixed income, from the perspective of equity market drawdown, the ability to mitigate equity market drawdown, and which led to the asset segment work. Without going back into details again, I'm very pleased to report to you that that work adopted by you and encouraged by you for the staff to work on has performed exactly as we expected since it was implemented, which is to mitigate the drawdown to mitigate the impact of a market drawdown. In addition to the new asset allocation, we also negotiated $6 billion capital injection from the state. We also sought the amortization schedule from 30 years to 20 years. So all these actions together really put us in a better place in preparing ourselves for the next inevitable market drawdown. Here I would like to highlight that this is a showcase of a partnership. We have achieved all this is really a partnership between you, the trustee, us, the staff, employers, employees, and policymakers. And we should continue to foster this kind of partnership to bring the best for the system. So I just showed you what has been done, between the trustee, between the staff, and the employee, and policyholders. What else we are working on? So in order to answer that question, it's important to see what could happen. What are the awful things could happen during a market drawdown? So we list 4 of them. The first thing is that we run out of money. When the market drawdown comes, we cannot pay our bills. We cannot fulfill our obligations. And the second one is that we miss the opportunity to take advantage of market dislocations. Remember the happy face that I showed you a moment ago during the 1981 recession? The reason happy face because if you had the dry powder and the courage to deploy capital at that time, you would have earned a higher return. So in order to do that, you want to make sure that when the market drawdown comes, you do have the dry powder on hand. So the first 2 things. So these are 2 awful things: either run out of money to pay bills, or you don't have money to take advantage of new opportunities. In order to mitigate this impact, we are developing a proactive and a comprehensive liquidity management and action plan. So these plans are ongoing project we are working on. This actually is the first project for the investment office. We know they will tell you that this is the first very first project I asked on my very first day when I returned to CalPERS. And currently it's sponsored by MID Kevin Winter and led by a group of people from various departments at CalPERS, such as Michael Cream, Robert Patterson, Dan Bienvenu is ensuring that all the resources are needed because it is so important for us to be ready for the next market drawdown. And Eric Beckison and his team is all involved. The fixed income team is all involved. The last 2 awful things could happen in a drawdown is that we cannot maintain our risk profiles. When the market drawdown comes, we panic. We cannot maintain our desired risk profile in the portfolio. And the last thing is we panic. We sell assets that crystallize loss. So the last 2, we can mitigate the impact of the last 2 by having strong policy and guidelines. So these are to make sure that we stick to the plan when the crisis comes. To deal with the first 2, we need to develop a plan. And to deal with the last 2, we need to stick to the plan when the crisis comes. So what else can we do? So as I said, that our preparation, we develop an action plan of what to do, and equally important, what not to do. And we implement a centralized liquidity and leverage management. So this project started already even before I came back. And again, this is led by Eric Beckson and his team and the entire investment office. So we're making progress in this important project already. Then we also implement a more real-time monitoring and scenario analysis. So that's part of the project that I'm personally very deeply involved with. We also, after we review all these, we may need to update some of our investment policies to allow for faster response, because most of our investment policies and guidelines are designed for normal times, not for the crisis times. So that's our preparation, and then plus your partnership. So what I mean by your partnership is that we work together, we develop a plan together, so we all be part of the plan. And then when the crisis comes, we all support the plan during the drawdown. So with our planning, preparation, and your partnership, we have a strong defense against a market drawdown. But it's very important to note that with all these actions, we can only mitigate the impact of drawdown. We are not going to eliminate completely the impact of a drawdown.
Before you go forward, I have a question, but Ms. Frost, do we need to start our workshop now, or can we wait a little bit longer? We're about 10 minutes past.
That's what I was just checking on flight times.
Yes, let's take a pause in Mr. Ming's presentation and start the CFA Institute.
Very good. Thank you. Thank you, Mr. Meng. So that brings us back to agenda item 7, the asset class overview. Who's going to introduce this?
Good morning.
Good morning.
Thank you very much for your patience. We were just getting organised there to make sure that Jeff could make his flight, because he's coming from here to going off on a 3-week vacation with his partner. So we're just delighted that he can join us again. So let me just briefly introduce Jeff. For those of you who remember, he joined us last month to kick off the first of our new series of board education workshops. And we're thrilled in this to be able to partner with the CFA Institute, that's the Chartered Financial Analysts Institute, and also the Council of Institutional Investors. And it's very nice to have Amy Boris, the Deputy Executive Director, here with us as well for CII. If I could just borrow the clicker for a moment, Ben, unless you're in clicking mode still. So just a brief recap on what we're doing today. This second workshop forms part of a series of education which has come out of the board's self-evaluation process that you went through last year, facilitated by the National Association of Corporate Directors. And several board work streams were formed, and Ms. Rogers and Ms. Taylor have been in the lead on the work stream around board education. The second important point is that the board as a whole sets delegations for each of the committees. And that's a fancy word for saying what does each committee have as its responsibilities. And let me go to this as well. The CalPERS pension buck, I think Ben just explained very eloquently why we care about the success of the investment office is because the fiduciary duty that the board has in overseeing the assets of this system on behalf of members, protecting that by understanding risk and protecting members' interests by doing the best job we can, as Ben says, to do the right thing in the right way and stick to our plans is very important. But in that, the partnership with the board is fundamental. So this education process is really to help us all understand the responsibilities of the board, the committees, staff, the consultants, because in that partnership, we're going to be able to do the best job we can for our members. So a quick reminder on what the board's delegation to this committee includes. Top of the list is strategic asset allocation. And the degree to which the asset allocation is successful really will determine whether you, as a fund of any size, manage to achieve your objectives. The asset allocation is the single most important decision that you will oversee as the board. So in terms of building out the curriculum for the investment committee, with the board work stream in the lead here, has been to say, well, the first part of the curriculum which we completed last board meeting is to look at the fundamentals of risk and return. That's really the equation that underpins everything that we need to do for protecting our members. Then what we're doing, starting today, is having a session on each of the 4 main asset classes. Fixed income today, we'll then turn to public markets with global equity, then we'll be looking at real assets, and then private equity. And then the final session will be to bring it all together in a workshop on asset allocation. So it's my pleasure now to hand over again to Jeff, who has this wonderful introduction, which I absolutely love. Bonds are not boring. I feel we should be wearing that on a T-shirt. I don't know if Arnie would like to bring that forwards for our global fixed income team. But bonds are not boring. They do play a vital part in CalPERS' achievement of its investment objectives. And again, it's very much our pleasure to have Jeff Bailey with us. As you know, he's not only a trustee, So he understands the mighty responsibilities that each of you assume when you join a board. But he's also got tremendous experience in the public sector, as you know, working for the Board of Minnesota. And he was a CFO for many years for a very successful corporation, Target. So, and also, Jeff, you serve on the board of the CFA Institute itself, which is a great public service to everyone. So with that, let me hand the clicker to Jeff, and we'll take you through the second workshop in our series. Thanks, Jeff.
Thanks, Ann. I should do a brief correction. I was never the CFO of Target. I'm Chief Investment Officer, not the CFO. My old boss, the CFO, would be outraged if I tried to claim his position. So I'll leave it that way. But it's a pleasure to be back. I enjoyed our meeting last time, and I'm hoping we can have the same sort of interaction that we did the last time as well. I thought the questions you had were excellent, and please keep them coming as we move along here. And Ann and Ben will kick me under the table if I end up getting wound up and don't give you time to ask those questions. So please feel free to do so at any time. If you remember last time, we covered risk and return basics, and that was a very wide-ranging set of topics, and we had a lot of discussion on issues across the spectrum. Today, we're going to be on a much more focused topic, and that's fixed income investing. And we're going to look at this asset class from the trustee's perspective, and I think that's important. I've found in my experience as a trustee on boards and foundations and pension funds that the issue of fixed income investing is maybe one of the most confusing because I think trustees on those boards have a hard time understanding the role of fixed income in their investment programs. It's not immediately obvious. So as we go through this discussion today, I want to emphasize I'm not trying to turn you into portfolio managers. You shouldn't be portfolio managers as trustees. That's not your role. You're setting investment policy for the organization. So understanding the role of fixed income is different than understanding all of the very intricate nuances of fixed income securities. But understanding what fixed income can do in your portfolio and what it can't do, I think, is really the focus for today. And before I launch into talking about bonds are not boring, which I absolutely believe, let me give just a real quick technical disclaimer. I'm frequently going to flip back and forth between referring to fixed income securities and bonds. I think it's important to understand that if you're going to be very technical about it, bonds are really a subclass of fixed income securities. I mean, there's all sorts of different types of fixed income securities, and bonds are maybe the most important subclass of those. But I think it doesn't do any violence to the discussion to use them synonymously. In fact, I think practitioners a lot of times do. They'll just say bonds when they really mean this broad class of fixed income securities. But if you get into a highly technical cocktail party discussion, you do have to understand that there are fixed income securities that aren't bonds. I mean, you can think of CDs at a bank, for instance. That's a fixed income security, but we wouldn't call it a bond. But there's lots of other examples like that. So as long as we know that going forward, I'm going to flip back and forth between referring to fixed income and bonds and move on from there. So let me just introduce this idea here in a very conceptual way. As I said, bonds aren't boring. I firmly believe that. Used in the right way for different funds, they have a very important role to play, and that. The role of bonds for an investment program changes quite a bit, moving from mission to mission to mission for different types of funds. If you go to a large endowment fund at some of the universities, you may find that they have extremely low allocations to bonds. We can have a debate over whether that's a good idea or not, but it's a fact that they might have single-digit sort of allocations to bonds in their portfolio. On the other hand, if you move to a corporation that was fully funded, it had closed down its pension plan to new entrants, it's quite possible that you see virtually 100% allocation to bonds. And then, of course, you find pension plans across the country that are open to new members, and as most public funds are, they'll have significant bond allocations in their portfolio, but somewhere between that very low allocation and very high allocation. It really depends upon the mission of the pension fund, and we'll talk a little bit about how that mission affects that allocation to fixed income in the portfolio. Bonds are not boring, but they're definitely misunderstood, and I think that's one of the goals today, is to try to clear up some of those misconceptions about bonds. They aren't boring in the sense that they can have quite a bit of volatility in the portfolio, especially if you have bonds that have a very long maturity. In other words, the end date of the bond is quite a ways out. You can, on an annual basis, you can have a lot of volatility in the returns in the portfolio. That doesn't mean they're a bad investment or that they're an exceedingly risky investment, but they do have that sort of volatility. I think more important is the fact that bonds have this very low, high-quality bonds have this very low correlation with equities, and we're going to talk a bit more about that. I think trustees, in a very intuitive way, understand why they have equities in a portfolio. So in other words, they recognize equities, risk assets, we'll call private equity and public equity, these sort of risk assets. They understand why they have them in the portfolio. They're meant to drive returns to earn that large chunk of the pension, the CalPERS pension buck, for instance. And they realize that putting those in the portfolio serves that purpose, even though that they're fairly volatile. The high correlation that stocks have with the economy is what causes stocks to be risky. In other words, we talked about this last time, the idea that when the economy is doing poorly, because stocks represent ownership in corporations, and corporations' outcomes are a function of how the economy is doing, stocks are likely to do poorly in an environment where the economy is poor. Vice versa, when the economy is doing well, stocks are going to do well. And that's just a compensated payoff for the fact that it's inconvenient, to say the least, to have stocks do poorly in a poor economic environment. That's the time when you have the least flexibility to make additional contributions to the investment program, when it's most expensive to you to have a poor performance. So what investors in stocks expect to get paid in normal environments, they expect to get paid a premium for owning that particular type of investment. It's less, if you think about fixed income, high quality fixed income, it's the opposite side of the coin. So high quality fixed income, U.S. Treasury is going to pay off regardless of the fact of whether it's a poor economic environment or not. And as a result, there isn't that premium that's attached to owning fixed income and securities. And so as a result, you get relatively low expected returns compared to equities. And that makes them somewhat problematic for portfolios, because those low expected returns don't drive the performance of the portfolio the way that equities do. So it's understanding that element is there, that I think is confusing for trustees, because again, they see the reason why they have equities in the portfolio, they're less clear why they want to have fixed income securities in the portfolio. There are ways to incorporate bonds in a portfolio. I refer to it as risk budgeting strategies that, combined with other asset classes, can create portfolios with really very attractive risk return profiles. But it's not something that's immediately obvious to most trustees. In spite of the low expected returns on portfolios, and the fact that as interest rates change, the returns on bonds can either go up or go down, bonds have, again, this key element that no other asset class really has, and that's this dependable low correlation with equities. And that is a valuable feature. And it's that feature that we're going to talk about a fair amount today, and why bonds end up getting into portfolios so often. So with that, again, stop me if you have questions as we move along. Let me start with just a few fundamental fixed income concepts. And I'm going to take you down a list of what I consider to be probably the 7 most important. There are plenty of other fundamental concepts related to fixed income, but I view these as exceptionally important. First of all, let's just start with a basic understanding. Bonds represent an obligation of an issuer to make specified payments to the owner of the bond at specified times in the future. So we think of interest payments on a periodic basis. We think of principal payments. Equities, as you know, don't have any promises to pay. That's residual ownership in a corporation. If the corporation does well and you've paid off all the financing of the corporation, the shareholders have what's left over. And so there's a lot of upside in that sort of situation. Bonds don't have a lot of upside, high-quality bonds. I mean, I think there's a saying among bond investors, the best thing that can happen is you get paid. So you get your interest payments, you get your principal payments, and you move along. And that's the promised payments are those interest payments and the return of principal for most bonds. Now, some bonds just make interest payments and principal payments, but other bonds may only make a principal payment. Zero coupon bonds are a classic example of that, where you buy the bond and it just makes one payment at the end of the life. And there are a whole host of different variations on those sort of interest payments. Mortgages make monthly payments. Corporate bonds tend to make semi-annual payments. The variety of different types of payments is seemingly infinite. But the important point is that there are these promises to make specified payments at different points in time. Something that we'll talk about a fair amount today is that bond prices are inversely related to interest rates. We'll get into that in a little greater detail. But basically, the notion is if interest rates rise, that makes bonds that are paying the current, let's say bonds were currently 5% and interest rates rose to 7%. The 5% bond just looks less attractive, and for reasons we'll talk about here in just a minute, a little bit of the math, but the notion of interest rates rising just makes my current interest rates less attractive, so the bond price is going to go down. Flip side, if interest rates decline, the current interest rate I have on the bond looks attractive, and that means that bond price is going to go up. So this inverse relationship is fundamental to bond. All bonds experience that sort of relationship. Fourth, the longer is the maturity of the bond, the more sensitive is its price to changes in interest rates. We won't go into that math here. That's a little bit more complex than we want to get in our examples. But if you think of a 30-year Treasury bond, its price is much more sensitive than a one-year Treasury note or Treasury bill. As you extend out the life of the particular bond, for the most part, it's going to become more sensitive to changes in interest rates, its price, that is. So that's something to bear in mind as well. Number 5, bonds with longer maturities typically yield more than shorter maturity bonds. And again, we're going to drill down on this just a little bit more, but this is this idea of what's called an upward sloping yield curve, that a 30-year bond typically yields more than a 10-year bond, and the 10-year bond typically yields more than a 1-year bond. There are all sorts of examples where that doesn't hold true. It's not some sort of fundamental law of finance that has to occur, but it is typically the case that longer maturities yield more than shorter maturities. Number 6, lower quality bonds yield more than higher quality bonds almost invariably. We refer to this as a credit spread, and again, we'll drill down on this further. But the general notion, of course, is that bonds with lower quality have a greater chance of default, and I want a higher interest payment for that, the risk that I may not get paid by the issuer. And then lastly, number 7, and I think this is important to bear in mind, bonds are just simply more complex financial instruments than common stocks. And it's sometimes hard for non-investment people to grasp that. Companies themselves are complex, and that makes stocks interesting. But with some notable exceptions, a stock of company A is the same as a stock of company B. It operates in the same legal structure. And bonds, on the other hand, are incredibly diverse. I mean, in terms of the maturities, the subordination of payments, the different types of coupon payments, the collateral that backs them up, embedded options. I mean, these are all extremely complex sort of issues. And not only that, but one company can issue many different types of bonds. And so bonds themselves are, as I say, complex financial instruments. And in trying to understand the bond market, it pays to understand that complexity.
I have a question, Mr. Bailey, from Mr. Jones.
Thank you, Mr. Chair. Yeah, Mr. Bailey, on the item 5, bond with longer maturity, typically, I notice you say typically,
It's important.
yield more than the shorter term. And so my question is that currently the gap, the yield curve is closing. In some cases, it's actually inverted. So what's going on in the market to cause that inversion on these long-term versus short-term bond yields?
Well, Mr. Jones, there is a lot of discussion of that, and I don't claim to be a financial market forecaster. I mean, I think most of the discussion you're referring to is this idea that the yield curve, which was, and we'll see an example of this in just a few minutes, was steeply upward sloping 4 or 5 years ago, is now basically flat, where short maturity bonds yield essentially the same as long maturity bonds. You know, there's different arguments about why Fed actions might drive some of that, what market expectations are. You know, all bond yields are a function on the short end of the Fed and its open market operations, and on the long end are all sorts of supply and demand decisions on the part of issuers and purchasers, and inflation expectations and economic outlooks. It'd be wrong for me to try to give you a definitive explanation of that. No one I know of knows the definitive explanation of that.
Yeah, if I may just add to that, typically it's upward sloping. When the flat or inverted, that's what sometimes people say that's an indicator of the next recession. So on average, when that happens, 6 months to 18 months after the curve inverted, that's the next recession. And this time around, we first saw the curve inverted in March 2019. And a moment ago, when I mentioned that New York Fed and San Francisco Fed, they both forecast the probability of a next of a drawdown in the next 12 months. One is 30%, one is on 44%. But they both use the indicator of the curve, is it inverted or not.
I'm glad that Ben threw himself on that forecasting grenade, because I don't actually want to get anywhere near that.
That's why I have not mentioned our own forecast. I use New York Fed and San Francisco Fed.
So, yeah, I mean, it's exceedingly interesting. There's no doubt about it, and it's true. The correlation in the past has been that flat yield curves or inverted yield curves have been associated with recessions, but you know, the yield curve has been pretty flat for well over a year now, and nothing's happened. So it's really hard to say. It's an interesting question for sure. Okay.
Go ahead.
Oh, all right. Let me go back to this. Several of the fundamental concepts we talked about. First of all, is this idea that bond prices are inversely related to interest rates, and that longer maturity bonds are more sensitive to changes in interest rates. And this graph illustrates that. This is a very simple bond. It makes annual coupon payments, and I have a 10-year bond and a 1-year bond. And essentially, what we're showing here is the idea that as the yield on these bonds increases, the price declines. The price is on the vertical axis, the yield is on the horizontal axis. And the simplest explanation I could give for something like that would just be an example. Let's say that I promise to pay you next year $100, and that current interest rates were 5%. So the question is, how much would you pay me today for that promise to get $100 a year from now at 5%? Well, I could take $95 roughly and put that into a savings account at 5% and have $100 a year from now. Okay, so I might pay you $100 or $95 for that promise to get $100 a year from now. Now, let's say that interest rates went up to 7%. What would you pay for that promise? Well, I could take $93 and put that into a savings account and have $100 a year from now, roughly $93. And so I would only pay $93 for that promise. That promise is a bond, and so interest rates went up, the price of that bond goes down. I mean, that's the very simple math behind it. And it works under all conditions. Interest rates increase, bond prices go down. And so the The sensitivity is important to understand, too. You can see the gold line there is that 10-year bond. The 1-year bond is the gray line. It just simply is the case, and again, we'd have to go a little deeper in the math than I care to, that the 10-year bond is going to move it to a greater degree for that 1 percentage point change in interest rates. And so the longer is the maturity of bonds in your portfolio, the more sensitive they're going to be to changes in interest rates. They'll always be inversely related to interest rates, bond prices. But the longer the maturity, the more sensitive is going to be that bond to changes in interest rates. It's probably a good moment to just note, too, about bond pricing. It's probably more art than science. And it's important to understand the bond market itself is what's referred to as an over-the-counter market or a dealer market. There isn't a New York Stock Exchange of bonds for the most part. There are some small organized exchanges that don't matter particularly much. For the most part, it's a dealer market. When you want to buy a bond, you have to call up the dealer and get the price, and hope the dealer has the right inventory for you and make the purchase. The Treasury bond market is exceedingly deep and liquid, and the prices that you see quoted for Treasury bonds are usually very firm. That really isn't necessarily the case for corporate bonds of even large companies. Many bonds just don't trade that frequently. They tend not to be extremely liquid, and the bid-ask spread is referred to the difference between what you could buy it for and what you could sell it for. Sometimes those spreads can be surprisingly wide. And because bonds don't necessarily trade frequently, a lot of times the prices are actually that you see in your portfolio are estimated prices. Now, the systems that they use to estimate those prices are actually pretty robust, but still, it's when you think about bond pricing, it's not the same as when you think about stock pricing. On my iPhone, I can sit there and look at prices of all sorts of stocks, and I have a pretty good idea at any given moment what the price of Target Corporation is. On the other hand, I don't have on my iPhone the price of any particular bond outside of Treasury bonds. And so as a result, you really don't know until you actually try to buy or sell the bond what the price for that bond is. But that's just a brief aside. It's not critical for what we'll be talking about today. Mr. Jones, the yield curve, this slide is getting back to your question, and again, it's an excellent one. You can see in 2013, this is the yield curve. It was very upward sloping, and maybe I should step back just a second. The yield curve is the yield to maturity on bonds of various maturities, and it's important you have to have everything else be the same. So in other words, the quality of the bond has to be constant. And that's why people usually, when they talk about the yield curve, practitioners will refer to the Treasury yield curve because we know that the Treasury bonds are all of equal quality. So that's typically how it's expressed. But you can see in 2013, the Treasury yield curve was very steeply sloped. Short-term interest rates were bordering zero. While on the other hand, the long bond was, the 30-year bond was out at 4%. Then fast forward to the end of March and really effectively today, you can see that the yield curve has shifted down a little bit today versus March, but it's essentially the same sort of pattern where the short maturity treasuries are yielding almost the same as the long maturity treasuries. And that's referred to as a flat yield curve. Every once in a while, the yield curve will actually tip the other way, where short treasuries will out-yield long treasuries. And almost always a steeply sloped yield curve, inverted yield curve has been associated with a recession. Flat yield curve, it's a little less clear on the relationship between the two. But we're in interesting times, let's put it that way, in the bond market. The other side of this is credit spreads. Again, everything being the same, lower quality bonds are going to out-yield lower quality bonds are going to out-yield higher quality bonds. The difference between two bonds of different qualities is referred to as a credit spread. And most of the time you'll see credit spreads expressed relative to treasuries. Again, treasuries are a great benchmark to compare things to. And so when we think about the the reward for owning lower quality bonds, we usually compare the yield on a bond to the treasuries. The bond market somewhat arbitrarily distinguishes between investment-grade bonds and high-yield bonds, and I'm sure you've seen these terms before. Investment-grade bonds are rated, if we're looking at the S&P scale, they're rated AAA down to BBB, and then high-yield bonds are any bond that's rated below BBB. And there's a range of different types of high-yield bonds. Again, S&P or Moody's is trying to estimate the default possibilities for those bonds. So bonds that are more likely to default are going to get lower ratings than bonds that are less likely to default. Investment-grade bonds, this AAA to BBB, usually yield in excess of Treasury, somewhere around 125 to 150, 1.25 to 1.5 percentage points higher than Treasuries of similar maturities on the longer end here. High yield, it can be incredibly volatile. As you can see on this graph, the gray areas are periods of recession, recent recession. So you can see the dot-com bubble in the early 2000s and the Great Recession around 2008, and you can see that these yields, credit spreads spike significantly in that period of time, and that's of course because investors at that point have a flight to quality. They don't want to own these bonds. They sell the bonds, and that, remember, interest rates are rising, so bond prices are going down. These are periods of time when investors are fleeing and moving towards higher quality treasuries oftentimes. So you see these big spikes in credit spreads. And the interesting point, again, Mr. Jones, to your question, I think credit spreads right now are not particularly wide. So if you look at investment-grade spreads, historically they haven't really moved out a lot. So if you think of the bond market as trying to forecast the economy, and you said, well, a flat yield curve or an inverted yield curve is a sign of future economic troubles. That may be true. It's also the case that the credit spreads aren't widening out, which would also be something that you'd expect the bond market to be reflecting if it was worried about the future economy. So it's an interesting conundrum for individuals looking at the bond market and trying to use it as a forecasting tool. Very difficult. Questions? All right. Let me shift gears just a little bit, and I want to talk about different types of bonds. So this list does not do justice, let me be clear, to the great variety of bonds that are out there, but it'll get us started. At the top, quite appropriately, are U.S. Treasury bonds. This is the bedrock of fixed income investing. The idea that U.S. Treasury bonds are the gold standard of fixed income investing, I don't think is an overstatement. There's no probability of default unless Congress decides to voluntarily default on its debt. The government always has the option to print money if it really wanted to. And so since it pays in dollars and the government owns the printing press, it ultimately could pay off in dollars if it had to. So the idea that Treasury bonds could default is really a very small probability, if any probability at all. There are two types of Treasury bonds. One is nominal bonds. So the idea that the interest rate is just expressed in current terms. So currently U.S. long Treasuries are yielding somewhere around 2.5% or so. Those yields are expressed in current dollars, in a sense. There's no adjustment for inflation that goes on. There is a class of U.S. Treasury bonds called Treasury Inflation Protected Securities, TIPS is the term, where the interest payments and the principal payment at the end of the bond's life are actually adjusted for inflation. So that protects completely against movements in the consumer price index if you're a bond holder. Those are a relatively small segment of the Treasury universe. Most Treasury bonds are actually nominal bonds. with a tiny portion issued in inflation-protected terms. Other countries also have inflation-protected bonds. They don't call them TIPS, but a wide number of countries actually issue those sorts of bonds. But again, nominal bonds are the more common form of bonds. Government agencies also issue bonds. So the United States government has different agencies, and these various units will issue their own debt. The government's promise to repay is more or less secure. I think many years ago, it was kind of a hypothetical. In 2009, it became real when Freddie Mac and Fannie Mae ran into financial difficulties, and the government essentially didn't step in. It was a severe crisis for government agency issues. So those organizations have been reconstituted, but the issue of government agency debt is always a question of will the government actually back it up the way it does with U.S. Treasuries, where the full faith and credit of the United States stands behind those particular bonds.
We have a question, Mr. Bailey.
Yes,
Mr.
please.
Jones?
Yeah, thank you. Yeah, on the inflation-protected TIPS bonds, earlier Ben was talking about the possibility, what happens if there's a deflation? And so these TIPS, do they have a floor during a deflationary period? And are we always protected with the principal?
That's actually an interesting question. They only have a floor when they're newly issued. In other words, if you have a bond, a TIPS bond that has a large accretion of inflation to it, it can go backwards. So the floor is ultimately the par value, but the par value is in nominal terms. So if you started out at 100 and you had several years worth of inflation built into the ultimate principal value of the bond, and all of a sudden we had multiple years of significant deflation, you could actually move backwards till you got to 100. So,
but the principal would be protected.
The principal itself would be protected, but that's in nominal terms.
Right.
So that's it's an interesting hypothetical, and in periods of time when it seems like ages ago, but in 2009 and so forth, and that was actually something that people that investors that own TIPS actually paid attention to. They'd buy on the run TIPS. Because they actually didn't want to buy TIPS that had a big inflation accretion built into them.
Yeah, just to add, the principal floor protection, I believe, only exists in the United States inflation-protected securities. The inflation-protected security in other countries do not have the principal floor. So if you do get into the deflation scenario in other countries, the other type of inflation-protected security, you could lose your principal if you have a deflation.
So my question is, do we have any TIPS in other countries?
Linker, that is the UK, and there are some other countries. I believe Australia has it. Japan,
Canada.
No,
yeah, Japan, Canada.
Do we
own it? International. That's. Give me a second.
Okay.
Barney, please. Oh, you do.
We do currently, although in fairly small amounts, and that's one of the things we're going to be discussing in closed session.
Okay.
Right.
Thank you.
Okay, Mr. Bailey.
Next on the list, I've placed municipal bonds. Municipal bonds obviously are issued by state and local units of government. I put them in more for completeness than anything else because the vast majority of them are tax exempt. They typically don't show up in pension portfolios. There are taxable municipal bonds that sometimes do find their way into pension portfolios, but it's not very common. Corporate bonds are issued by private businesses, entities of varying quality, and so we talked about investment grade bonds and high yield bonds. There are an amazing variety of types of corporate bonds outstanding. I put down mortgage-backed securities. They're the most prominent of a broader type of fixed income investment referred to as asset-backed securities. Basically, the idea is homeowners will borrow from banks, and banks will issue mortgages, and then there are entities, typically the federal government these days is the only organization doing that will gather in these home mortgages and package them up into pools of mortgages. And then those pools, they issue securities related to those pools, and the owners of the securities get a pro rata share of the monthly mortgage payments and ultimately the principal payments. And there are a set of rules that determine the various prepayment and repayment risks that go along with those particular mortgages. But the important idea is that we're taking a whole bunch of underlying fixed income securities, these home mortgages, and packaging them up into a pool and then selling pieces of the pool to investors. It's an amazingly efficient process, the securitization process. And despite the problems that subprime mortgages ran into in the Great Recession, it's a very effective way to provide liquidity for the mortgage market, and is very helpful for homeowners. So it's a valuable piece of the fixed income universe, and pension funds have found them to be useful investments in their portfolios. Lastly on the list, and again, I want to emphasize that this is not an all-inclusive list, but I listed non-U.S. securities. Governments and corporates, I think Americans tend to lose track of this, but America has by far the deepest corporate bond market in the world. Most countries actually finance their corporations through bank loans. So the vast majority of non-U.S. bonds are usually some sort of government-type securities, and those can be issued in U.S. dollars, in which case there's no currency risk for investors in the U.S., or they might be issued in local currency, in which case then the investor has to decide whether to hedge that currency risk or not. So, again, I think the point I want to make here is there's an incredibly broad range of types of fixed income securities that a pension fund could be owning. Fixed income investing risks. I have this long list here, and this isn't meant to imply that somehow bonds are dangerous investments or anything like that. I think it goes back to my notion that bonds aren't boring. There's a lot of things that impact the value of a bond. And even high-quality bonds are subject to all sorts of interesting portfolio risks. And I won't go down the entire list here. They're exceedingly interesting if you're a portfolio manager. For a trustee, I think the two most important risks are the interest rate risk and the credit risk. The interest rate risk we've already referred to, because we've talked about the idea that bond prices are inversely related to interest rates. So if you own a portfolio of bonds, you run the risk that interest rates might rise. That's going to drive down the current value of your investments in those bonds. Credit risk, again, we've discussed that. This is this idea of default and the idea of the credit spread, but the idea that an issuer might not repay, or at least repay on time, the interest and principal that was promised is something that outside of the U.S. Treasury market, any bond investor incurs. So it pays to understand how much interest rate risk and how much credit risk is built into the portfolio. The other items, as I said, are much more second-degree sort of portfolio management issues that your portfolio managers pay a lot of attention to, but as a board, I think it's of less interest to you. All right, let me now move on to fixed income benchmarks. And you recall, we talked about, at our last meeting, we talked about the properties of a valid benchmark. I listed 5 at that meeting. I said the benchmark should be unambiguous, so we should understand the composition of the benchmark or the process by which the benchmark is built. It should be laid out on the table, completely transparent. The benchmark should be measurable. We should be able to calculate its performance on a reasonably frequent basis. It needs to be investable. You should be able to take the benchmark and passively invest in it, if you so choose, rather than to implement the particular investment process that is on the table. The benchmark should be appropriate. The risk of that benchmark should be very similar to the investment process that you're benchmarking against. And lastly, it should be specified in advance. In other words, a benchmark can't be assigned after the performance period has occurred. So these are properties of all good benchmarks, and fixed income is no different. What we see in the, and we're going to talk a little bit further about this, but what we see in the fixed income world is there are typically broad bond market indices, and those broad bond market indices can be subdivided and recombined to create specific benchmarks for various investment mandates. And it's that sort of discussion that I think boards should have with their staffs about how they build those fixed income benchmarks out of those broad bond market indices.
We have another question, Mr. Jones?
Yeah, thanks. On the component of measurable, and I'm thinking of CPI plus 3, so, or investable rather.
Right.
So how do we invest in CPI plus 3?
Well, we actually used that example last time, and I think it's a great question. It's not really a good benchmark. There's nothing I know out there that's an investable alternative that you could passively use as your default, and therefore it's problematic as a benchmark. It's aspirationally, that's great, but in terms of evaluating the performance of an investment program or investment manager, I think it's very problematic.
And just to add a little historical context, if you'll recall, infrastructure a while back had a CPI, I think it was CPI plus 4 in the past. And that's one of the reasons why we moved all of the real assets onto the, what was Odyssey and now the MSCI version of the Odyssey benchmark.
Yeah, and we still have one asset class, private equity, is a public equity plus 150. And that was a good compromise because there were no private equity benchmark investable. And later on, we'll talk about that. That creates a number of challenges. And one of them, since the benchmark is not investable, but we have a fixed allocation target to private equity. And when we cannot get to the targets, there's nothing we can do. So that is one of the challenges still in the portfolio.
Okay, thank you.
While I'm on the topic of fixed income benchmarks here, and that last bullet point, subdividing and recombining, the idea, let me just take that just a bit further and talk about a couple of ideas related to that. If you, let's say, had a investment manager only invested in long treasuries, and you could conceivably take a broad market benchmark and slice out only the long treasury piece of that particular benchmark. And you might create a benchmark that you assign to that particular manager that was just simply the long treasury piece of the aggregate benchmark. There are different ways to do that. I'm not going to try to say that there's only one way to accomplish that goal, but that's an interesting use of broad market indices to create benchmarks for specific investment mandates. I think as you do that, and we're going to talk about this a little bit further, it's important to monitor the appropriateness of the benchmark for any individual investment manager. Managers tend to gravitate towards more risk inside their investment mandates. They're assigned a particular niche of the market to operate in, and the natural tendency is to own riskier assets in that portfolio. And that makes sense. Those are the higher yielding assets, and over the long run, hopefully produce the higher return. But that doesn't necessarily mean the benchmark is appropriate for that particular manager. If you've taken more risk than the benchmark, should you be scored in a positive way? That's one of the big questions that I think so many staff have when they deal with outside investment managers is how they keep an eye on the investment guidelines associated with that manager. And it's not always easy.
A couple of questions, Ms. Taylor.
Yeah, actually, this is, I think, for Ben. I was just wondering, do we have out of benchmark holdings in the program for fixed assets?
For fixed income?
Fixed income, I'm sorry.
Out of benchmark holdings.
Essentially, Ms. Taylor, you're referring to bonds that aren't in the benchmark itself, but
Right.
are being held by the manager who's being benchmarked against.
A manager or our own internal portfolio. I think that's a question for Arnie Phillips.
Oh, there he comes.
Good morning. Arnie Phillips, head of fixed income. Yes, we do, in certain of the asset types, do have out of benchmark holdings. So for instance, in the mortgage-backed portfolio, the benchmark will have simply agency issued mortgage-backed, so Fannie Mae, Freddie Mac, Ginnie Mae. We will also own agency or mortgage-backed securities issued by, say, Bank of America or JP Morgan. So they're not guaranteed by Fannie, Freddie, or Ginnie, but we do an assessment of the collateral and get a comfort level that we are being compensated for that. So we do own out of benchmark exposures in fixed income.
That's one example. Clearly, that's something that was not a good thing for us in 2008. So what have you done differently in terms of your research on those securities to mitigate the issues that we may have run into in 2008?
Sure. So we own almost no non-agency now. We had taken advantage post-2008 when the prices dropped and invested around $300 million or so, which is less than 5% of the mortgage portfolio in those types of securities. The lesson clearly, though, is the underwriting is what matters, and pre-2008, the underwriting was clearly questionable. We had positioned ourselves to be in what we expected to be a good position, but clearly housing was much worse than anybody anticipated. And so, you know, the lesson learned, though, is there's no shortcuts for doing the analysis. And looking at, Ben had shown some distributions up there, looking at the extreme tails is extremely important. They may not seem likely, but you need to look at them just to understand the downside that you may encounter if you come into those types of environments.
So you don't feel like we're in the same situation with those mortgage-backed securities?
Certainly not in the housing market in the U.S. right now, no.
Okay, thank you.
Ms. Brown?
Thank you. My question is for the presenter, or maybe it's more of a statement, but I really appreciate you talking about how managers may gravitate towards more risky investments to surpass the benchmark. Therefore, they're getting a higher return and they get to keep their jobs or make more money. My concern, though, is also for our staff, because we have benchmarks for our investment staff, and they earn bonuses based on surpassing benchmarks. And I want to make sure that when we set those benchmarks that we are taking into account risk, that if in fact even our own staff is making riskier bets in order to surpass the benchmark. So I hope we're looking at that. I know that's imperfect comp. I don't sit on that committee, but I really want us to take notice of what you're saying. It's not just about our outside managers, it's also about our inside managers as well. Thank you.
Mr. Jones.
Yeah, thanks. I want to go back to Ms. Taylor's question about the mortgage-backed securities. In the 2008, 2009, mortgage-backed securities had tranches that were ranked A, AAA, and you had some in there minus D, and that's what caused the problem. So what have you done to be sure today that these mortgage-backed securities do not include tranches that are subprime, if you will?
You're exactly right. There's the underlying collateral, which you can determine the quality of it, and then there's the second tier of protection through the tranches, as you gave the example of AAA down to non-rated. And even through the pre-2008, we had the AAA tranches for the vast majority of our holdings. So the anticipation was, and to a large extent, a lot of those did survive through that environment, but even some of those that were rated AAA by rating agencies turned out to not be gold-plated. So again, the the rating agencies have become much more conservative in their underwriting post this financial crisis. Investors have taken a look at the governance that goes around the process, in the sense that there were rules in place that dictated the trustee needed to act in the benefit of the entire trust. And yet, in some cases, some of the settlements and stuff forced some of the losses into investors. And so a large group of institutional investors, including ourselves, have not gone back into those structures because those protections have not been changed. And so at this point, most of what you're seeing in quote, the non-agency side of the market is actually super prime borrowers, sort of the best of the best. We are starting to see a little bit of issuance more at the fringes, but still the overall underwriting criteria in the mortgage market is extremely high right now, and still pretty challenging for folks to get loans outside of the agency products, primarily Ginnie Mae. And so the products that on the non-agency side aren't that appealing to us because of the quality being too high to actually make it attractive. But even if they were high enough, we don't like the governance and lack of changes that have occurred since the financial crisis, that we still would not re-enter that. And that would be certainly a lesson learned, that the documents were written a certain way, but they weren't always implemented in what our view is of how they should have been implemented. And without those changes, it's not a market that we find investable right now.
Thank you.
Please continue.
And Mr. Chair, the only thing that I think would be helpful for some of the newer board members is that we did recover about $250 million from the rating agencies, as well as hundreds of millions of dollars from the individuals who were selling, or the entities who were selling those assets.
Thank you.
On slide 13, talk about the composition of the broad bond market indices. And what I've posted here is the Bloomberg Barclays has a series called the Aggregate, and they have a U.S. aggregate version and a global aggregate version, and it's somewhat instructive to look at how those are allocated. Essentially, this is virtually all bonds over a certain maturity. I think it's 1 year, and you can see that in the U.S. market, there's roughly 40% in treasuries and 30% in these securitized, mostly mortgage-backed securities, and another quarter in corporates. The world is more treasury type of securities. As I mentioned, the corporate bond market isn't anywhere near as large in the rest of the world, and the mortgage-backed security market isn't a feature so much of those other countries. I think there's a couple of things that takeaways when you look at that. Passive management relative to those particular indices is a bit more problematic than it is against equity indices. It's possible to just simply go out and own the S&P 500 and say that you've invested in the U.S. equity market and feel quite comfortable with that. When it comes to the broad bond market indices, the issuers determine the composition of the indexes to a greater extent than is true for equity markets. So, in other words, if you think about the IPO market for stocks in the United States, it's tiny compared to the overall size of the U.S. stock market. So we can have all the uber IPOs we want, and it really doesn't move the needle very much in terms of the composition of the U.S. stock market. But the U.S. bond market, the government, corporations are churning out new bonds all the time. The government's running record deficits, and those bonds go into the indices here. It's hard to imagine, but in the late 1990s, we were running surpluses, budget surpluses in the United States, and there was a concern that we were going to run out of Treasury bonds. Hard to believe that today, but around the mid-2000s or so, the U.S. aggregate was, I think, somewhere on the order of 20% Treasuries, and today it's 40% Treasuries. Well, that doesn't mean that your portfolio should move from 20% to 40%. You have to make a decision on why you have bonds in your portfolio. That's critical. And I think most sponsors, trustees to set the investment policy and the staffs that implement it are leery of just owning the broad bond index because they recognize that there's this sort of dynamic that goes on. But that's not necessarily then very instructive about how you go running a passive portfolio for your investment program. And so I think what you see in a lot of organizations are different names for it, but enhanced indexing in some form or another, with the notion that, look, I don't want to run an aggressive, active fixed income program. I want to look something like the broad bond market, but I'm not quite sure I know exactly what the broad bond market is that I want to look like. And so they give their investment managers a considerable amount of leeway to own additional corporates or more treasuries. In other words, it wouldn't be just a fixed 40% treasuries today, 25% corporates, and so forth. There's usually some sort of guidelines that are given to the investment managers and some sort of responsibility to stay closely near the performance of that particular index. A lot of these instructions can be somewhat contradictory, and that's what makes passive management somewhat more difficult when it comes to fixed income investing than for equity investing. It's not objectionable to have this sort of discretion. I think it's just important, incumbent on the part of trustees and staffs to understand how much potential tracking volatility they might be taking on with the discretion that they give the investment managers. These are discussions that should really take place as the investment policies are being set up. The appropriateness of the benchmark versus the particular strategies that are being implemented, I think, is the key issue here. Trustees and staff should understand how much risk is actually going into their portfolios versus what the benchmarks are stating. All right. You saw this slide last time, and I think it bears repeating. The standard paradigm, as I said, is that stocks beat bonds and bonds beat cash. And stocks beat bonds by an incredible amount. And we just showed here from 1970 through the end of 2018. But these numbers are true for just about any long time period that you want to look at in United States history. The notion that stocks beat bonds then oftentimes brings up the question, why not 100% equities? And it's an interesting question. There's a modestly famous article written by a gentleman named Cliff Asness back in the 1990s that had the title, Why Not 100% Equities? And I think the data show that if you were somehow able to constantly rebalance. If you're 100% equity, there's no rebalancing. If you are willing to hang in there for that entire period of time, 100% equities is going to be the greatest wealth generator on a historical basis that any other strategy. Asness came to, go ahead, Ben, if you have a comment.
Sorry, this is very much related to the topic of my talk. If you go back to one slide, slide 14. So if you look at the top blue line, the equity, in the long run, you realize return much higher than bond and cash, provided you can sustain the drawdown. So the highly importance of a drawdown, prepare yourself for the drawdown.
I couldn't agree more. I think Asness answered that question, and I think most practitioners tend to agree with it, is that we don't see 100% equity portfolios because investors really aren't long-term investors. If they have a 100% equity position. In other words, they have a tendency to exit those positions too soon. And so that creates, as Ben was showing in his set of slides, if you can't stay in the market for that, in those down periods, if your desire ultimately is you're concerned about the viability of the fund and you're 100% equities and you pull out at exactly the wrong time, that's the worst option.
Yeah, so that's exactly what I meant early on. Stick to the plan. Most people cannot, and most people cannot be a long-term investor.
So as a result, it's unusual to see pension sponsors with long-term horizons that, even though they claim they have long-term horizons, that have extremely high equity exposures, 100% or 90% or even 80%. We do see some endowment funds in that range, large endowment funds, but it's unusual, let's put it that way, for large institutional investors to be 100% equities or close to 100% equities. So for the next few minutes or so, I want to spend some time talking about the case for fixed income. And I say the standard case, and I don't mean that derisively. I mean, these are 4 very valid reasons why you would own fixed income in your portfolio. I highlight 1 and 3 because I think they're probably the most prominent, but 2 and 4 are interesting as well. I think as we get going, it's important to agree that we'll be talking about low default probability fixed income, and that means essentially U.S. Treasury bonds or extremely high quality corporate bonds. And the reason I say that is, as you start to move down the quality spectrum, you start to bring in different forms of equity risk into the portfolio. And you may desire to do that, and there's nothing wrong if that's part of your policy, but it starts to obscure the reason why you own fixed income in your portfolio. You're trying to capture some of the equity risk premium. And again, that may be you may have a valid reason for doing that, but that isn't really what we mean when we say high quality fixed income is owning lower quality corporate bonds. So let me move to the reason number 1 here, the volatility dampener. And this is by far the most important and common rationale that sponsors have for owning fixed income. And as Ben's alluded to in his discussion earlier and just a moment ago, the idea is sticking to the plan. Equities experience this huge volatility, and few long-term investors can stomach the volatility. That's just a fact. They exit at the wrong time, and selling at the bottom is by far the worst strategy. I'm going to repeat a couple of slides that we saw from last time. And here are equity and fixed income annual returns. And you can see the year-to-year performance of U.S. Common stocks, U.S. long-term government bonds, and Treasury bills. And you can see those significant spikes down in U.S. common stocks. And as recently as the Great Recession, we saw almost a 40% decline in one annual period. So that's what I mean when I talk about a bumpy ride and the inability of most investors to be able to hang in there in those environments. While it's true that bonds have volatility of their own, and these are long-term government bonds, remember the longer the maturity, the more volatility you have in those return series. They don't experience anything like the volatility of common stocks. You can see bonds are roughly half the volatility, and these long-term government bonds are half the volatility of stocks. The other thing that I want to point out when we think about volatility dampener, and these go together, is that fixed income exhibits this low correlation with equities. Again, we're talking high quality fixed income when we're referring to this, but it is the asset class with the lowest correlations, reliable correlations with equities. So I showed this slide before, and I'm just going to repeat this idea of correlations again, just very briefly. When you think of correlations, we would measure that as falling between a -1 and a +1. And when we think of a +1, we're thinking of the picture on the left, where we have 2 return series that just move in lockstep with each other. One goes up, the other goes up. One goes down, the other goes down. That would be a positive correlation, and it'd be close to 1.0. On the right side, you see a negative correlation, a very negative correlation, almost -1.0, and those would be a series, a set of returns where when one goes up, the other goes down, predictably.
Can I fit in a question?
Yeah, please.
Thank you. Ms. Paquin?
Oh, thank you. So I was just curious, are there any situations where bonds and stocks are performing the same way? In other words, both going down?
And we'll stick with high quality bonds, right?
Yes.
Okay. Yes, I'm going to get to that in just a moment. I think it's a great question. Just give me a couple of slides and we'll move into that idea. But I think the big thing that I want to drive at here is we prefer in the portfolio to have assets that are at least 0 to low single digit positive, or low 0.1, 0.2, 0.3 correlations. It's the correlations that get up towards 1 that are dangerous for the portfolio in terms of adding volatility. And in periods of strong or downdrafts or drawdowns, we're going to see in those situations the most pain. And Ms. Paquin, I'll be to that in just a second, but this is a historical view of this. So this is from 1926 to 2018. If we look at annual returns, long-term government bonds have a correlation with stocks of essentially zero, and that's the big draw for stocks, or bonds in the portfolio. Long-term government bonds is they have that very close to zero correlation. If stock markets are going up, we don't know necessarily that bonds are going to go up or go down. There's effectively no relationship between the two, and that's a valuable feature to be able to incorporate in the portfolio, and that's why bonds make it into pension portfolios. This is an interesting question, too. So we say that bonds and stocks are not highly correlated, and we have to be a little bit careful of that. This goes a little bit to your question, and I'm going to get to your question in another slide as well. It depends upon the quality of the particular type of fixed income security. So this shows the correlation to the S&P 500 along the horizontal axis there, and on the vertical axis is the yield on those bonds. And what you see is, and this is the reason that bond investors tend to stretch for risk, is that the lower the quality of the bond, the more it tends to correlate with the S&P 500, but also the higher is the yield. So if you look in the upper right side, you can see U.S. high yield, USHY. You can see different types of emerging market debt. Those are all very sensitive to movements in the U.S. economy. And so they have a high correlation with the S&P 500. But because they act a lot like stocks, they have higher yields. So there's a lot of volatility there, a lot of correlation with the stock market, but you get compensated for that. If you go to the lower left, you can see various maturity U.S. Treasuries on the far left. You can see developed countries like Japan and Germany, whose debt is quite secure. So you see that these bonds have a much, in fact, this is a 15-year period, have a very low correlation, a negative correlation with the S&P 500. So that's why I wanted to talk about only high-quality bonds as we got into this. As you talk about lower-quality bonds, you actually find positive correlations with the broad U.S. stock market. If you put high-quality bonds in a portfolio, you get a diversification benefit. And this is what we see in this slide. Again, we saw this slide before, but I just want to reiterate some of the key points there. That the average return on U.S. stocks over this very long period of time was almost 12%, while the return on bonds was about 6%. The volatility of stocks was almost twice that of bonds. If we just put together a very naive 50-50 mix of those two, you see we lose about 3 percentage points in return over that historical period, but we drop the volatility by almost 8 percentage points. So there's a trade-off there, and only trustees can make that decision about whether they're willing to take that sort of trade-off. I mean, that's your job when you set investment policy. Are we willing to accept some of the longer-term reduction in expected returns versus the significant reduction you get in volatility? And I'm not suggesting a 50-50 mix is the right one. It's just for educational purposes here. But regardless, whether you're 60-40 or 70-30, you get those sort of impacts. And it's up to you in setting investment policy to make that allocation. But there are significant diversification benefits in terms of risk reduction to owning bonds. And then lastly, to your point, Ms. Paquin, I think this is where this sort of gets interesting. These are 50-50 stock bond real drawdowns, and Ben explained drawdowns earlier, and we saw this in our last session. Basically, a drawdown is I like to think of it as once your portfolio experiences a negative return, you keep measuring its performance, and you don't stop measuring it until it gets back to zero. And so you look at the performance, let's say back in the 1970s, and you could see blue is the S&P 500, and these are inflation adjusted. And then gold is the 50-50 stock bond mix. And again, inflation adjusted. So what you see is that bonds in that period of time, they provided some protection against the drawdown. It wasn't quite as severe as with stocks, but it was pretty bad. And the reason being, of course, the 70s was a period of very high inflation, and high inflation impacts bond returns. And so bonds got hit pretty hard, their returns, and they weren't as valuable a diversifier in the portfolio in the 1970s. Now, move into the 2000s, inflation wasn't really an issue in the 2000s. And you can see that bonds were significantly protected against drawdowns. So the correlation of stocks and bonds in the 1970s was actually greater than the correlation of stocks and bonds in the 2000s. And in my mind, the biggest reason for that was the inflation issue going on. So what happens in the 2020s? I don't know. We have very low inflation right now. Is that likely to be an issue? I guess my looking glass isn't that powerful. So something to think about. I think in any event, and this is something I would really emphasize, bonds still provided diversification, even in the 1970s, which was a period of historically bad inflation for the United States. Never experienced anything really like it outside of brief periods around Civil War and World War I. I mean, this was high inflation, and would we experience something like that? Perhaps, but even then, bonds provide protection in the portfolio. I think this is the other thing that's interesting to pay attention to, is that these correlations do change over time. So I said over the period 1926 to 2018, the correlation between long-term government bonds and stocks was 0 in the United States. That was the average. You can see in the late 1980s and early 1990s, it was positive. It certainly wasn't 1.0, but it was more positive than it is today. And then there was a big change in regimes in the 2000s that drove it into negative territory. Over average, it's close to 0.
If I may add something here, exactly as Jeff just said, that inflation is part of it. And if you look at 80s and 90s, the correlation between stock and bond is positive. So it means that there's a less diversification benefit. For more diversification benefit, you need lower correlation or negatively correlated, ideally. So a few years ago, Bridgewater had a research paper on this topic. And their argument is that in the 80s and 90s, so if you look at the nominal interest rate, it's made up by two components. One is the risk-free rate, the real yield, plus inflation. And according to Bridgewater, that research paper from Bridgewater in the 80s and 90s, most of the surprise of the nominal yield or in the economy coming from inflation. And if that's the case, when inflation surprise on, say, for example, on the upside, you have all of a sudden you have hyperinflation that hurts both the stock and bond. So it means that they both go down together, so correlation is positive. And if the inflation, the surprise on the negative, say you got deflation, so that's on the other side of it. If the surprise is caused by uncertainty in inflation, stock and bond tends to be positive correlated, as Mr. Bailey has mentioned. And then since 2000, when there is regime shift, so after the experience of 70s, 80s, and 90s, the Fed had and the global central bankers had become much more effective in terms of managing inflation. So from 2000, the regime shift. From 2000 onward, the surprise in the economy really coming from the real interest rate part, less so from the inflation part. If we had another chart here, you will see the inflation from 2000 become much more tamed. So when the surprise coming from real yield or real economy, so when the economy is doing well, it's good for stock, bad for the bond. And when the economy not doing well, it's bad for stock, good for bond. So that's why you see negative correlation. So from 2000 onward, we see the negative correlation between stock and bonds. So we started having some diversification benefits. We need lower or negative correlation to have the diversification benefits. Now the question is that from today going forward, what's the regime? Would that surprise in the economy more coming from inflation side or the real yield side. So that we don't know. But back to Jeff's point, the correlation between bond and stock is dynamic, and the diversification benefit between stock and bond, what we may get in the next downturn is really depending on the correlation. What's the new regime we are in?
No, that's an excellent point, and I definitely won't get into politics, but it's important. I think bond investors pay attention to, as the president Job owns the Federal Reserve. There's a lot of, you start to worry at some point about the whether inflation could creep back into the American economy. For the last 15 years, everyone's just assumed that wasn't a key issue. Going forward, it's certainly something that no one's panicking about at this point. But if you thought that the Fed was really going to end up being a lot looser in a time of huge budget deficits, I mean, it's conceivable that you could go back to those periods. Again, my crystal ball is not very good, but it's something that bond investors, I would assume, would worry about. All right. Reason number 2 why investors tend to hold fixed income. This is something that's a little bit more of a history lesson than anything else. But even within my lifetime as a professional in the investment business, deflation hedge has always been a reason why pension funds might own fixed income, high-quality fixed income. If there was ever a deflation, fixed income would be the place to be. There isn't any doubt about it. The evidence in the Great Depression, you can go back and look at the returns on fixed income at that time. Fixed income significantly outperformed equities. If it was your only reason to hold fixed income in your portfolio, it's pretty expensive insurance, but as I said, it's hard to argue that it doesn't work. In these days of 10 years of a strong economy, sort of fades in the back of your mind that deflation could be a problem, but it certainly is, as Ben pointed out earlier, in Japan, you had periods a long period of time when there's essentially zero or a deflationary sort of environment. In Europe, treasury yields are negative in some countries. It's not really that much of a hypothetical. We just don't recognize it in the United States at this time. But fixed income would be very productive in a deflationary environment. Liquidity management is another key reason, I think, why pension funds in particular own fixed income. High quality fixed income, it can be bought and sold essentially at almost no cost. Treasury bonds trade very liquid, and so it's a great buffer, as I say, and a low cost way to manage your liquidity. Probably 4 ideas that go along with that liquidity, and different organizations view them in different ways, but fixed income is a very fungible asset that can be sold if needed. So to rebalance equity positions, if there was a significant equity market drawdown, it'd be easy to sell high-quality fixed income and invest back into equities. A lot of fixed income serves as collateral for derivative positions. It's a very cost-effective way to do that. Again, you're earning interest on your holdings at that point, so it's much more productive to hold it in bonds than it is in cash. And so they provide that sort of ability to meet margin calls if necessary. It's dry powder in the case to deploy it in other asset classes. Some organizations use it as a place to place funds that are ultimately going to go into private equity or real estate in some future capital call. And lastly, they fund benefit payments. I mean, fixed income generates income. So it can help pay for the benefit payments. It certainly is liquid if securities need to be sold to bridge some period of time in between contributions. So it's all of those are key elements of the liquidity management, and it's. I think all organizations, even large endowment funds, will have fixed income in their portfolio simply for liquidity management. And lastly, and again, we won't get into this, this is for an asset allocation discussion at some point, but I do want to point out that there are attractive risk-reward characteristics to balanced portfolios. This is a much more nuanced view of fixed income. As we discussed, the expected return on fixed income is lower than equities for reasons that make complete economic sense, but you could conceivably create portfolios with fixed income in them that had higher expected returns. It would require some sort of leverage in the portfolio, and that sometimes is controversial among pension sponsors, but I'm always a little bit in awe that pension sponsors would find owning 80%, not that you folks do it, but owning 80% in various private equity and public equity and so forth, not controversial, and using some sort of levered position of equities and fixed income. Both of them have risk associated with them. The whole idea of you're taking risks to try to earn higher returns. There are ways to incorporate fixed income into a portfolio that targets certain levels of volatility. This whole idea of risk parity is involved in that concept, and I'm not trying to promote risk parity, but I think it's an interesting application of that. And it points out to the fact that it's possible to separate the risk decision from the asset allocation decision. That's the big thing that I would try to drive home. And so fixed income could be part of a portfolio that if you wanted to have a particular risk level, you could achieve that risk level even having that fixed income in the portfolio and possibly earn commensurate returns with equities. So it's something for discussion.
Before you go on, Mr. Rubalcava.
Thank you. I think this slide actually runs into the question I had in the previous slide when talking about liquidity management. It drives the question as well, if one of the issues you have, one of the reasons you have fixed income is to be able to have a source of liquidity for, buy the withdrawal or purchase, whatever. Then it's a question, you mentioned it here now, so I think maybe I should have just waited, about it's a question to have in consideration when you set up your asset allocation process. So I guess the question is, never thought of it this way. I guess when you're talking about how to allocate your assets, I guess you have to think about, you also have to have some ability to lose your fixed income so you can sell it for something else, I guess. I never thought about it this way. How much does that come into play? I'm not sure if that's for Ben or something.
Yeah, so during our 4-year cycle asset liability management workshop 4-year cycle, we explicitly consider liquidity. So we have a liquidity allocation, particular allocation to liquidity, currently target at 1%, and then we have a 28% allocation to fixed income. Granted, not all the 28% are equally liquid, but ballpark, the 28%, I would say 10% of U.S. Treasury securities, very liquid, and there's another 14%, 14% mortgages that rather liquid as well. So I would say the majority of the 28% of fixed income is very liquid. And on top of that, we have 1% allocation just to liquidity, super liquid cash, almost cash-like holding 1% of the total fund.
Thank you.
Microphone, please.
Thank you. Home stretch. A few items I wanted to mention about fixed income and its compatibility with expected return targets. And I think public funds, and I'm speaking in very general terms here now, not just CalPERS, but public funds have tended to have very sticky expected return targets. And they've, despite the fact that, as I show in this slide, that interest rates have been on a long secular decline since the early 1980s, you haven't seen significant declines in the expected returns on most public fund portfolios. And again, CalPERS is not alone. In fact, I commend you for a lot of the changes that you've made. They're ahead of many other organizations. But if you would say that, and as Ben noted, I think very well in the presentation that he had earlier, but if you think of treasuries as the bedrock upon which you would say that risky assets are priced, it should be the case that your expected returns on risky assets decline as the expected returns on high-quality fixed income declines. And we can measure the return on high-quality fixed income on a regular basis. I can get out my iPhone and look at what the 30-year Treasury is right now. And I promise you, over the next 30 years, if you bought that bond and just held it and reinvested your interest back into that bond, that you'd end up with the current yield of about 2.5% or so. That's just the nature of fixed income, high-quality fixed income. So if we think of then this high-quality fixed income as the base, and then we apply some risk premium to that to calculate what we think our return on our risky assets is, it must be that as the yields on long treasuries decline, the yields on those risky assets should decline. Now, we've been in a Goldilocks period since the Great Recession that's been quite amazing. Everything has exceeded expectations. Inflation has been better than anyone thought it was going to be. The economy has been better than anyone thought it was going to be. The Fed has been more accommodative than anyone thought they were going to be. Stocks have done better than anyone would have thought they were going to perform. Your job as board members and the staff is to say, what does the future look like? And so that has to be a very objective sense. And it is amazing that we've had these great stock returns over this period of time, but as long treasury yields decline, I think objectively you have to think that the expected return on risky assets has to decline as well. I can't tell you exactly what that is. That's for your asset allocation modeling to get into. But we don't see the significant decline in the expected return on assets in most public pension plans. 8.5% to 7% is an important move, but it's not reflective of the significant move in long treasuries over that period of time. And I like to think of this in terms of fixed income and its compatibility, in your case, with a 7% discount rate. I like Ann Simpson's pension buck. I think it's really a nice visual for trying to think about how this works. I'm kind of a finance guy, so I put stuff into formulas. Pictures, not quite so well. But I say benefits are equal to contributions plus investment earnings. I call that the fundamental law of pension finance. There isn't any other way around that. And your pension buck is built right into that formula. And so the higher in the investment earnings, the lower potentially is the contributions. Similarly, the lower are the contributions, the more your investment earnings have to be able to pay the same level of benefits. And benefits are only paid out of realized earnings. They aren't paid out of expected earnings. So you can put a target on it, but it's only what you earn that's important. And so I think what we've seen among most public funds is that if the will to make additional contributions is lacking, then the burden starts to rest on the investment earnings. And so in an expectational way, organizations try to push more into the expected earnings. And that's a problem, as we saw from that previous chart, that if long-term treasury yields are declining significantly and expected return on equities aren't following that, how do we try to make our adjustments here? Well, I think we end up taking more risk in the portfolios, and that's what you've seen across the country is that empirically there's absolutely no doubt about it that public funds have taken on more equity risk in their portfolios since the Great Recession, and certainly that's worked out over the last 10 years. Will it work out in the future? I think one way to think about that is doing the math on your expected returns, and I'm sure you've been through this a little bit. Your capital market assumptions I have under those expected returns, and if you just take a weighted average, in other words, take the policy allocation and multiply its weight times the particular expected return, you end up with 6.7%. There's a volatility penalty that goes along in a portfolio. Mr. Jones, you talked about the volatility penalty in a sense in your example. If you have $100 and you go up 50%, you get to 150, but if you go down 50%, you're back at 75. I mean, that's the equivalent of a volatility penalty, and that's what's going on here. So your arithmetic average is not your compound return over time, and there's actually a penalty applied to that. And I'll work out the math some other day, but it works out to a compound return of your 6.1%. That's what you have built into your capital market assumptions. And so you can see the fixed income expected return, and that's consistent with the way the markets are right now, essentially owning some corporate fixed income in your portfolio and mortgage-backed securities and so forth. It can get you to a 3.2% expected return, but still it's hard to get to the 7%. I think that's the takeaway from this. And so if you look how other organizations have tried to deal with this is public funds in fixed income allocations are modest. I think the numbers have, since the Great Recession, fixed income allocations in public funds have declined somewhere around the 33% mark down to 28% or even lower across all public funds. This particular database, the Center for Retirement Research in Boston, is showing fixed income at 21%. I think the important point is that fixed income allocations have declined considerably since the Great Recession, and the reason being that they just don't fit in the expected return calculations any longer. The yields are just too low. If you went back to the 1990s, the standard asset mix was 60-40. Everyone would talk about 60-40 as the asset mix, and today no one talks about 60-40. And the reason being, it just doesn't generate the expected return that people would like to plug into their calculations. And I understand the pressure, but it's a question of how that ultimately is going to play out. And just to conclude on that then, as I said, I think the simple answer is that fixed income just doesn't really square with a 7% discount rate, or worse in some organizations, 7.5% or 8%. And so something has to give, and public funds have responded by moving into higher risk assets, private equity being the more prominent feature of these plans now. And so I'd like to conclude by just simply saying that taking higher risk doesn't guarantee higher returns. Taking lower risk is always going to get you lower returns, but taking higher risk doesn't do it. And it's understandable, again, why organizations are pushing on that particular lever. But I think the ramifications of taking higher risks are only going to be clear in the next major downturn. And at that point, we'll find out how those strategies work. I think my bottom line conclusion is I think fixed income is still a relevant part of investment portfolios. Bonds aren't boring. They should be part of your investment program. They just have to be properly rationalized in your fund. And that's a lot of discussion on your part with your staffs. So with that, I'll conclude. Happy to answer additional questions.
Great. We do have a couple of questions, but I want to thank you for your time today. Great presentation. Great helped with a lot of the questions that are still coming. Mr. Perez.
Thank you. The graph on page 31 shows that it's a 2017.
Yes.
Is there much change from today?
To the best of my knowledge, not. That was the latest available that the Center for Retirement Research had. I pulled that from a late 2018 article. So I don't know.
Thank you.
Ms. Taylor.
Yes, thank you. So I guess I think it's important that we have fixed income, especially for liquidity issues at a later, if we do have a downturn. I was wondering, Ben, if we, I think our investment consultants are here. I was wondering if Makita wanted to opine on any of this, if they wanted to give us their own opinion on this, or had any different conclusions, or.
Makita's not here.
Or Wilshire and PCA, that's fine too. Makita is here.
Alan Emkin, Makita, thanks for asking a question.
we agree with everything Jeff said. It's basically bonds 101. And it's good to get that education. But I would urge you to go back to Ben's presentation earlier and not focus on the 10-year period, because you're an institution that will live long beyond all of us. And in fact, the 7% number is based upon a 50-year horizon, and that's what should be driving the decision, not the 10-year.
Great. Thank you. There you go.
Took me a minute. Sorry. Andrew Junkin with Wilshire. No, I agree. This is great primer on fixed income. I think putting it in relation to CalPERS, it's important to recognize the changes that have occurred over the past few years, and I think Arnie really hit on those, that fixed income is now really income focused, much higher quality, to try to address some of the concerns that came about in 2008. There's a saying that we always fight the last war.
Right.
And we probably are, but one thing about whatever the next battle will be when the stock market falls is that high quality fixed income is quite likely to do well, certainly treasuries, right? So I think that's kind of the shift that this committee has made over the past few asset allocations, in particular the one 2 years ago. So I think that's really beginning to show up.
Thanks, Mr. Junkin. Thank you.
Well, thank you all. Thank you again for the presentation today. Really appreciate it.
My pleasure.
We're going to take a 12-minute break. We will reconvene at 11:30, picking up the end of item 9 and then moving to item 8.
Exactly.